The following content is provided under a Creative Commons license. Your support will help MIT OpenCourseware continue to offer high-quality educational resources for free. To make a donation or to view additional materials from hundreds of MIT courses, visit MIT OpenCourseware at ocw.mit.edu.
So we're gonna sort of come back to central banking. I thought it was appropriate to have two classes on this when I was laying out the whole semester in August, thinking about how to build the class. In part because central banks play such a significant role to the world of finance, but it's really about their role in money. I mean, money and central banking have been so intertwined for 300 or 400 years, and they are the custodians, in essence, of what fiat money is. And of course, this course is blockchain and money. Many of the things we're talking about here actually do relate to Bitcoin and crypto finance, even though a central bank digital currency doesn't have to be tied to a blockchain technology. So I'm going to do a little bit back to what we talked about Tuesday, partly because Rob Ali was with us on Tuesday. I moved up some of the content from today to then as well, just to go through that. Of course, if we do end early, we can always talk about Tuesday's election too. That's all right. So we're going to, as always, sort of touch on the readings. I'm going to be asking you all a bunch of questions about things like Ecuador and Senegal and Sweden and maybe the Philippines that were in the readings and so forth. But you know, it's all experimentation by those four countries and others. We're gonna talk a little bit about. I'm just going to try to come back to what we were talking about Tuesday and why, again, I think it's relevant to any course in blockchain technology, and particularly if you're interested in Bitcoin and crypto finance. Introduce a new subject, really, which is stable value tokens, which are a significant part of experimentation right now, again, in the world of crypto finance, but relate them back to the world of private banknotes. Because I see in the current approach to stable value tokens something similar that we saw in the past. Central bank digital currency, which we introduced on Tuesday, and that's going to be the bulk of what we talk about today. And you're going to, hopefully, we'll have a nice discussion to see what all of you think of these Sweden, Senegal, Ecuador, and the Philippines a bit. And so that's what we're going to try to do. Again, we're going to sort of dive into these questions as we go through those four countries. We talked a little bit about MasterCard when Shriyam was with us, right? Priya's husband was with us because he was with MasterCard, but we can touch back. That was really a reading for today, that MasterCard took out a patent on fractional banking. So central bank goals and functions. Anybody remember what we talked about Tuesday as to what are central banks about and what their main goals are and their functions? Anybody want to?
Maximum employment, price stability, and also the moderate long-term interest rate.
Wow, that's pretty good. You've got the three things that go into the U.S. dual mandate. So there's an economic function that central banks in almost every country have taken on some role to promote the economy, but dominantly it's about price stability. And how does price stability relate to money? Anybody? James, is that a hand up?
No, but I can give it a go. It's inflation.
All right,
Controlling inflation, making sure that...
I would add Fed fund rate, cost of money.
All right, so that's cost of money, right. So price stability and money relate because what's the three functions of money?
It's a dependable unit of account.
So a dependable unit of account, it's right in that. So the third function of money, store of value, medium of exchange, a unit of an account. So stable pricing is about making sure that unit of accounting, that unit of pricing, has some stability. Price stability is really about money, and it also promotes an economy. They sit at the center of the money system, central banks. At first, to check on the king, to make sure that the king didn't overspend when he was at war with another king in another country. That's where it kind of all started. But they sit right at the center of money. So the four things we talked about, they manage the nation's fiat money in every country. The supply, the price, the payment systems. Payment systems are how we move money around. So if you really want to, just boil down, you can take a whole course. There's wonderful professors here that teach central banking. But I would say manage the nation's fiat money. Oversee the banking system, because the banking system is a way to basically move money around the system, and provides credit. Tom, what does a bank do when it provides credit? Just use the word money somewhere in your definition.
It expands the quantity of money.
Expands the quantity of money, and how does it do that?
Lending money.
What's that?
Lending money.
Lending money. So banks stand in between investors or savers. We can call them depositors. So on the one hand, you have depositors or investors. On the other hand, you have borrowers. And banks are just in the middle. And that's why it's called financial intermediation. Intermediates, they're just in the middle. It's more than just being in the middle. I mean, it's a big role. But so the banks in the middle are all about money. And so central banks want to get involved and manage those institutions. Initially, commercial banks came before central banks. And commercial banks were around, and they kept failing, even in the time of the small Italian states. They would fail, and there was some family usually, or central authority that helped out. And ultimately, the central bank today it seems like the central banks came first, but the commercial banks kind of came first, and then there was a central way to protect the system. Central banks are bankers to their own governments. Paul Tucker, who now teaches over at the Harvard Kennedy School, but Paul Tucker just came out with a book. He was the deputy governor of the Bank of England, about the unelected power. And central banks are unelected usually. They don't stand before the voters. But they have a tremendous amount of authority. So the four types of buckets of things they do. So then we talked about, I used this chart the other day a little bit, but the three different types of money. Please.
In the context of cryptocurrencies, I would add also that the central banks have a key role in international payments and international reserves.
Well, so the question is, will central banks have a similar role for cryptocurrencies? Anybody want to take one side or the other about it? Aline, you think it's going to go to zero, so you would probably say central banks will not have any role if cryptocurrencies go to zero.
I'm not sure I understand the question. What do central banks have to do with cryptocurrencies?
All right, so Elaine just took the other side. He said, what does central banks have to do with cryptocurrencies?
I mean, if it's going to be a currency for one country, they will still need to manage international reserves and manage international cross-border payments. If it's going to be a global currency, then it's irrelevant.
So it's a hypothetical.
Well, I think it's a choice, right? It's whether you want your currency to float versus Bitcoin, or whether you want to defensively buy Bitcoin and hedge your currency. I think the central bank has a choice to pursue A or B.
So any other views on whether central banks will get deeply involved in Bitcoin and cryptocurrencies? British?
So I think if cryptocurrency can build a circle of its own in terms of transactions where it does not need to interact with the fiat currencies, then the role of central bank would be completely restricted to the governance of the activities it is handling, whether it needs to get involved in that based on the risk it poses to the system. But if it is interacting with the fiat currency at any level, then the central bank's role becomes more involved in that case.
More involved if it becomes more central. So isn't it possible that, I mean, we don't know what the future will bring, and Aline might be right. If cryptocurrency doesn't take off, then central banks can kind of just wave it away as some experiment on the side of finance. But if it starts to take off, I think, you pronounce it Guillermo? Guillermo. Says that if it becomes somewhat central, as Brodish and others have said, I think that there would be a role for central banks. If a country actually was going to use it as its medium of exchange, a unit of account, and a store of value, and particularly if there became fractional crypto banking, this MasterCard patent, like if you actually saw somebody taking crypto deposits and making crypto loans, and you had credit facility through crypto. We're a far way away from that. We're not there, but I'm saying if that happened. Sean?
So I was just curious, a follow-up on that is if that happened and it becomes a fraction of the monetary supply, and in order for the central bank to carry out its functionality, just like completing the open market operations, so does that also apply to kind of, if the cryptocurrency plays a role, does that also apply to open market operation to the cryptocurrency market?
Well, so Sean's asking if we really were in this world we're not yet in, and cryptocurrency was a dominant form of finance, banking, and so forth, would you envision the central bank trying to do an open market operation? Anybody want to tell the class what open market, it's not in the readings, but what open market operations are used for?
Is it increase or decrease in the money supply?
Yeah, so the central bank can buy some of the money or sell some of the money, which affects the supply and thus affects the price. So open market operations effectively affects the interest rate. You have often probably read the interest rate targets. The Federal Reserve has a target, but what they're doing in an open market operation is really buying and selling supply of money. And when you influence the supply of something, you change the price, and the price of money is measured in interest rates or foreign exchange rates. So, Sean, I would say that if it becomes a dominant part of an economy, then some central authority might want to try to influence its price, but there's a challenge. Does anybody want to guess what challenge I'm thinking about why cryptocurrency, let's say Venezuela was adopting Bitcoin as a central means in that country. What would be their challenge of trying to influence the price of Bitcoin in Venezuela? Aline.
We know about the other economies outside Venezuela that are using Bitcoin. Absolutely.
So Venezuela might be only a small portion of the overall Bitcoin usage around the globe. So it's one thing if you're one country and trying to influence the price of the currency that's in use in that country. If Sweden wants to influence the price of the krona, or Israel the shekel, but it's far more problematic if it's a worldwide currency. Hugo and then Tom.
I mean, I could see that being kind of like what we saw earlier this year or last year when there was like a Korean, the price of Bitcoin in Korea was higher than the price of Bitcoin in the rest of the world because there was so much demand there. So if you get like the central bank of a certain country buying Bitcoin in their currency, they're basically devaluing their currency in relation to Bitcoin, and it might not affect the world market in the way that they think it would, right? Unless they're like effectively buying Bitcoin on all open markets all around the world.
Right. And do you have a view as to why the pricing went up in Korea versus elsewhere? It's called the kimchi premium. Those literally, I don't make this up, but that was what it was called in Bitcoin, the kimchi premium, which was that Bitcoin was valued at a higher price in Korea than elsewhere. Hugo, do you have you had one reason you said it, just thought that the Koreans were trying to buy a lot of it, so there was a kimchi premium. Tom, we're going to get to you.
like in order to open an account on a Korean exchange, I think you have to be a Korean citizen. So like you weren't really able to arbitrage very.
All right, so Hugo, you're onto something. You're saying arbitrage. Ben.
So I believe it was difficult to arbitrage because of the capital controls in Korea. Is that something like
All right, so it's difficult to arbitrage. So the basics of finance, we're moving a little away from Bitcoin, but the basics of finance is arbitrage has been a part of finance for, again, thousands of years. If I can buy something in France and sell it for a different price in Switzerland, and it doesn't cost too much to travel the roads between France and Switzerland, I might buy it in one country, sell it in another, and that's called locational or geographic arbitrage. In a modern digital age, digital assets don't have much locational arbitrage. Oil still has locational arbitrage because you might be buying it in the Gulf Coast and selling it in Africa, or there might be locational arbitrage in physical commodities, but in digital financial assets, there's far little locational arbitrage. And it's interesting, in Korea's case, there was locational arbitrage. What was this about? And it was because it was hard for regulatory reasons. So there was a kimchi premium, literally, for quite some time because it was hard to move Bitcoin across the borders for regulatory constraints and so forth. But now we got Tom. You were going to say something.
When we talk about bank capital requirements, does the U.S. Federal Reserve require banks to hold in dollars, or are banks allowed to hold in any currency when banking?
Has anybody been in banking? Want to answer Tom's question?
Whether or not bank capital, bank reserves have to be held in dollar denominated.
Josh, you spent a lifetime in banking, right?
Yeah, so there's a lot of rules. A lot of the rules are based on the liquidity of the assets that you're holding. So if you're holding capital, if you hold it in treasuries, which are very liquid, and you can get out of them in a certain amount of time, there's a big premium to hold your capital in those types of assets. So I think the rules don't necessarily specify whether it's dollars or another currency, but they heavily favor very liquid.
Yeah. So Josh is right. It's all brought back to the home nation's currency unit, dollars or euros or renminbi. And some accounting books, it's brought back into that, but there's different haircuts or weights depending upon some perceived model of liquidity. So a U.S. Treasury bond versus a German government bond might have similar liquidity, and the regulators will count it the same, but you're on a very real-time basis using the foreign exchange rate to bring it back to the unit of your home country.
Yeah, I'm jumping the shark a little bit on my knowledge of finance and central banking, but thinking about whether or not Bitcoin becomes a reserve currency or whether or not banks hold it, to Guillermo's point of if central banks aren't allowing financial institutions to get credit for holding Bitcoins or cryptocurrencies, right, why would they have to do it?
Well, currently, central banks are not that favorable to Bitcoin and cryptocurrencies, but they're probably right. There's not a deep history, there's not a lot of liquidity, and there's high volatility. And the underlying markets are highly susceptible to manipulation. We don't know for sure what the real pricing is at any given time. But in the hypothetical world where it's becoming largely adopted, I would suspect that central banks around the globe would have some capital regime that would treat it more favorably than it's treated today, but less favorably than government fiat currency.
Right. I mean, you trust the German bond because you trust the German government and the central banks, the German financial.
Generally speaking.
Right. More so than you do a decentralized governance structure.
So 3 types of money that central banks are involved in. Does anybody remember? There's even a chart up here you can see. You can grab it from Akira.
Digital currency, central bank digital currencies. Fiat collateralized?
Wait, fiat what?
Fiat collateralized.
Fiat collateralized. No, we're going to get there. That's going to be about stable value tokens. I'm talking about
M1, M2, M3.
All right, so we talk about M1, M2, M3. So what's the first thing that you might think about?
Cash.
What's that? I heard the word cash, but some deposits. But starting with just cash is money. So did I make it green? Yes. There we go. Thank you. I got some help here. Cash. That's one form of money, and we all have it. Or actually, I've never asked. I always have cash in my pocket. How many people in this room actually currently have cash of some country in their pocket? So we're down to about 70%. But 30% have no cash in their pocket. You're putting yours away? $1. $1. If we were in Japan, it would probably be higher, though, right? So one form of money is cash. Another form of money that the central banks...
Central bank reserve.
Central bank reserves. Let's see if I made that green. Yes. So central bank reserves. Again, I'm just going back through this from Tuesday. Reserves started because there were commercial banks, and when government set up central banks, they said you have to save and put some of your money a reserve with the central bank so that we might give you deposit insurance, we might give you access to liquidity in hard times, which is called opening up some liquidity or lending facilities. So you have to keep a reserve from us. That's where the word came from, but it's a form of money. And the third form of money, the form of money that almost everybody in this room uses on a daily basis, the real form of money that we use almost all the time. So we had cash, we had central bank reserves. What do we actually use almost every day? What's that?
Deposits.
Deposits. So our bank deposits, we are actually transacting when we go into Starbucks. I know it doesn't feel this way, but you're actually moving some of your bank deposits to their bank deposits. That's how we're really moving money. So those are the three forms of money. We never see Federal Reserve or central bank reserves. We just see the cash and the bank deposits. Kelly.
So you talked about being able to facilitate lending when times are tough. So if we go back a decade, how have the rules sort of changed to prepare for that scenario where the central bank would need the ability to have a lot of money?
So Kelly's asking, we all lived through the financial crisis. How many of you in 2008 were in banking in any way? All right. So, Josh, you, yeah. Alpha, where were you working in 2008? You were at Goldman Sachs. Yeah, I've heard of them. The other people that raised their hands, who else raised their hand? Where were you working?
I was working for Bank of Tokyo Mitsubishi.
Bank of Tokyo Mitsubishi, I've heard of them. Very big bank. Josh, a hedge fund, right?
A mortgage hedge fund.
A mortgage hedge fund. We thank you, Josh. So the question is, how would Josh, Alpha, or Akira get money today? Did anybody work in central banking? No. So the 2008 crisis came along, and Josh, we let him fail. He was a mortgage hedge fund.
You did pretty good.
Okay. What's that?
So he let us fail.
He let us fail. Goldman Sachs got a bit of government support. Bank of Tokyo, Mitsubishi, did you get any government support?
No, we have some MBA, CDO, but not critical negative impact.
It was not critical. But the central banks around the globe, particularly here in the U.S., provided liquidity in multiple ways, but it wasn't going to be enough. They were providing liquidity, one, for some banks that were failing. Bear Stearns in 2007 failed, and through a legal authority they had from Congress from the 1930s, where you could actually lend to a financial institution. Actually, you could lend to any company in society, but they only they had never used the authority, but they used the authority that you could lend versus collateral, and that was done with Bear Stearns in 2007, and then it was done again in 2008 for others. And what did they do with Lehman Brothers? When the fateful weekend that Lehman Brothers failed, what did the Federal Reserve say to Lehman Brothers?
Let them go bust.
James said they let them go bust. That is correct. They said, we can't use this authority, and then, we all know, the history books have written how that fateful week in September 2008, then everything falls bust because there was uncertainty in the marketplace. And so what they did next, Kelly, so they were using traditional authorities, and what they did next is they started to test the limits of their legal authority, along with the Treasury Department and the Federal Deposit Insurance Corporation, and they put a series of other things in. And under an old authority of the Federal Deposit Insurance Corporation, they actually guaranteed all debts of the banking system in the U.S. for a period of time. Under other authorities, they figured out how to put a guarantee on money market funds. It was about $2 trillion in money market funds. All of these almost extra legal authorities, I mean, they were not written right into congressional law, into law, but they pushed the outer boundaries. And we knew when Larry Lessig was here, he said that every contract has some ambiguity, every law has some ambiguity. And the best lawyers at the Federal Reserve, the best lawyers at the U.S. Department of Treasury and elsewhere were thinking, where is the ambiguity? And can we use that uncertainty in the law to save the system? And then they went to Congress. They went to Congress and asked for $700 billion. When Hank Paulson, Treasury Secretary, went to Congress, they sent a 4-page, but it might have been 3-page legislative request for $700 billion. I remember I first read that 3 or 4-page request because the then senator from New York, Hillary Clinton, asked me, this thing's come up, will you read it and give me your advice? It didn't take me long to read 3 pages. It was an outright request for $700 billion. It finally did pass. It first failed in the House of Representatives. It became, I think, a couple of 100-page document. But $700 billion of U.S. taxpayer money went to the Treasury, and the Treasury then lent it out and so forth. So it was multiple things. 10 years later, a law here, Dodd-Frank, limits some of what the federal government can do. It tightened the ability to be the fire department in the midst of a raging fire. And there's lively public debate. Recently, Tim Geithner, who was Treasury Secretary at the time, has come out publicly, and Ben Bernanke, I think, and they've written an op-ed and some other pieces saying it would be good to loosen some of those Dodd-Frank restrictions. But there's others on the other side who said, no, we need to keep those restrictions tight, because if the restrictions are loose, then we have something called moral hazard. Does anybody know what moral hazard might be?
I think it's you run a risk that is not commensurate with what you can do, but you feel confident because you feel someone else is going to bail you out.
And who will run the risk?
It could be a bank or it could be another entity.
Yeah. So the banks or financial institutions, if you know you're going to be bailed out, will take more risk. It's human. It's who we are. So my father had a small business in Baltimore. He never had more than 30 employees. It was a cigarette and candy and pinball machine business. If he couldn't make payroll on Friday, the city of Baltimore was not going to help him out on Monday. His employees might give him another week or two. Hey, Sam, my dad's name's Sam, we'll give Mr. Sam another week. But 2 or 3 weeks later, they would have all quit. But the banks, so large, so tied into their economies for many decades, 2008 wasn't the only time, the sovereign steps in, the central bank steps in. So Kelly, the answer to your question is there's probably less ability for the central bank in the U.S. to step in. They still have very real tools to be the firefighter in the middle of a raging fire, but they're a little bit more constrained. We as a society spoke through our Congress and said we don't want bailouts. But in the midst of the next crisis, some Treasury Secretary and some Federal Reserve Chair and maybe some president will be testing the limits of those statutory authorities, and they might be knocking on the doors of Congress again.
I guess my question is more testing out the implications of if we were to have, for example, like if Bitcoin were to be backed by central banks, what those implications would be if, you know, say all of a sudden a ton of Bitcoin had to be issued, but we all know there's like a restriction on the supply there. So.
All right, anybody want to take the other side of Kelly's question? Bitcoin's now the currency that's in, hypothetically, the Bitcoin or some crypto. Aline would tell us it would be some other crypto. Maybe it's Algorand or something. What happens? What's going to happen to the flexibility of a central bank and a government to bail out their economy if it was a crypto?
Goes down, kind of like the example in the EU.
So remind me your first name.
Isaac.
Isaac. So Isaac says it goes down. What do you mean? It means that their flexibility goes down? Tom?
I mean, if it's a cryptocurrency like we know them today, it's impossible, right? I mean, there has to be a finite set of coins, tokens, whatever they are, and there has to be a consensus protocol that has to be decent.
Eric? So Tom contends, Isaac says it gets a lot harder. Tom says it's not just harder, it's impossible. Eric?
It depends on the design of the cryptocurrency platform that underlies the crypto that's being used, because we will see maybe later in this class there are some non-collateralized stable coins that actually have smart contracts that enforce money supply policies to keep the stable, which is really similar to handling money supply in an automatic way.
So Eric is saying...
We'll take one more.
Well, in the case of Bitcoin, right?
Remind me your first name.
I'm Santosh.
What's that?
Santosh.
Santosh.
If you control like the mining system, you can change the protocol. Just make it so that there's more coins.
So what Eric and Santosh are saying is there's some flexibility, either flexibility written into the algorithm or flexibility in that if 51%, if there's a consensus or hard fork, you might be able to adjust. But at its core, it's probably, as Isaac introduced it, it's harder. I don't know if it's impossible, but I think it's a lot harder. Just like the European Union has a lot harder time helping out Greece because you now have multiple countries involved in the decision making. The consensus, what satisfies German economics and German politics is different than what might satisfy Greek economics and Greek politics.
Aline, and then we'll move on. So I'm a bit confused because I guess we're switching terminology. So when you say central banks and cryptocurrency, you don't mean central banks and CBDCs. You mean something else? It's not. There's two worlds here.
Yeah. I think we're dealing in a hypothetical a discussion. What if a cryptocurrency were to actually take hold, like a Bitcoin in the future? I think that's what your questions were about, Eric.
Take hold, you mean be popular enough and used?
Popular enough, used enough as a store of value, used enough as a medium of exchange, and then there was a crisis.
Very different from CBDC.
Very different than a central bank digital currency. Yes. Last, and then
Serve sort of like in the old days, a stock specialist on the floor of the exchange where they made markets. You know, if there was hard selling, then they could actually come in, be a backstop or a floor for the price.
Andrew's asking, could the private sector be?
Could the central bank serve sort of like how the private sector really works? You know, there's specialists.
So could a central bank, in essence, come in and support a cryptocurrency? To some extent, for sure. Depends on what their reserves are, and they also, of course, are part of a government that has a taxing authority, has a military. I mean, there's a lot of extra might that comes with being part of a government. So I think the answer is yes, but multi-jurisdictional currencies usually fail. on some level. The euro is still an experiment. It may still fail some decades in the future. It's been tested, but multi-jurisdictional currencies in the past, the high probability is they usually fail because you don't have one political system, one unified set of government accounts, one taxing authority. There's a bunch of challenges. But let's move on and try to hit some of the things on. So that's kind of review a little bit of the other day. We said, what's fiat currency? We've talked about, of course, fiat currency then represents all three forms, bank deposits and notes and reserves, and it's accepted for taxes and it's legal tender. In this hypothetical case, we hadn't even gotten to whether would Bitcoin be accepted for taxes, would Bitcoin or crypto be accepted as legal tender. But I would remind everybody, whatever the future holds, I think wide adoption in any country, you'd have to address, will the government accept it for taxes? Will the government say it's accepted as legal tender? And unless that happens, usually wouldn't have wide adoption, even in a country that's in distress. And again, we're not talking about central bank digital currency, but you could say the same thing about central bank digital currency. Unless it's accepted for taxes, which it probably would be, or accepted as legal tender. So I wanted to go back to private banknotes. So commercial banks have issued notes in the past. Think of this as basically a piece of paper that represents a bank deposit. The same way that we might be moving mobile money now, think of it. But most of this was done before there was a time of central banks. And in the US, it was called the free banking era. Andrew Jackson was the 7th president of the United States, and he really didn't like a central bank. It was called the second bank of the United States, but he let it expire in the 1830s. Andrew Jackson, does anybody know what piece of currency Andrew Jackson is on? Where's his portrait? $20 bill, that one that we keep passing around and everything. Andrew Jackson also was president at a period of time that he paid off the national debt. Paid it off to zero. He was a Tennessean that had a strong view about finance. We had a very tough time in the 1840s, so I'm not sure we should have paid off the debt completely. But the free banking era, the notes that went around in the U.S. for 20 to 30 years were all banknotes. And then the Civil War came along, and the U.S. government needed to finance a war. And the word greenback comes from 1863, when the North, the Union, wanted to raise some money, and they literally started printing greenbacks. And also the first National Bank Act passed during the Civil War, and the National Bank Act set up something called the Controller of the Currency. And the Controller of the Currency, those two words, they confused me a lot when I was on Wall Street. Why was the bank regulator called the Controller of the Currency? But in the 1860s, it was to control all of these banknotes that were being issued by a bunch of commercial banks, most of which that failed, hundreds failed. Many of the pieces of paper would trade at different values, discounts to each other, and so forth. And some say that the world we're living in now with cryptocurrency, this new market, is a little bit like the private note period. Interestingly, there's two countries or two areas that still use private banknotes. Anybody from Hong Kong? James and Anton. So who issues your currency, your cash?
There are three banks, Bank of China, HSBC, and Standard Chartered. So Bank of China represents the People's Republic of China. HSBC represented the local Hong Kong, and Standard Chartered represented Britain.
That's actually, you should also add the monetary authority, because they issued a $10 note.
They do, but it's not really a private banknote.
Private notes, yeah.
Yeah. So in Hong Kong, the notes, the dominant notes, am I right? Or
yeah, anything over $10.
Anything over $10 is by a bank. They have to follow the rules of the central bank. And anybody from Scotland or Ireland? Oh, what's that, too far north? But similarly, in the United Kingdom, there's sterling banknotes. So we still do have some of this. There's still a little legacy of it left. Tightly, highly constrained legacy because it's the monetary authority, it's called in Hong Kong.
I don't actually know.
Or is it called a central bank?
It's not called central bank.
It's called MFA, the Monetary and Financial Authority.
Monetary and Financial Authority. So the word monetary is right in there. Just like in the 1860s in the U.S., the bank authority was called the controller of the currency. And it still is called the controller of the currency. James.
A little bit about the UK. If anyone ever travels to the UK and get a Scottish banknote, give it back to the person who gave it to you, because you spend it in England, everyone panics. It's like, what is this? This does not look like the usual banknote. It is technically legal tender, but people go, don't want it.
So it's not good north of a certain...
It's not good south.
Certain south of something.
Well, I thought I read that it's not legal tender in South, but it's also not legal tender in Scotland. So you can use them in Scotland as a matter of custom, I guess, is a question I had. But as a technical legal matter, it's actually not, it doesn't extinguish the debt, but somebody won't sue you by custom.
I believe Ross is right, but for those who don't know, Ross has spent a career as a bankruptcy lawyer, as a partner of a firm before he came back for a Sloan MBA. So I'll go with Ross on this one.
Moral of the story is, if you get a Scottish banknote, just give it back, because I don't want this.
There you go. So stable value tokens. What's the moral on this, James? If you get a stable value token, do you give it back?
Well, in theory, it's stable value, so you can exchange it for whatever it's tethered to.
Whatever it's tethered to.
So what are stable value tokens? And what value might they have? What pain point in the crypto space? Why did they come about? There was a reading on it, so maybe it was just...
I think they can use off the volatility of the cryptocurrency in a way that it's backed by either gold or currency, so that the volatility.
So volatility. So ease to dampen the volatility. Why would somebody want a crypto asset but ease the volatility? What are the use cases for crypto without volatility?
Well, they just mentioned like loans and savings accounts as a few examples, but the thing with the volatility is that it struggled as a store of value because it's not stable if it just goes all over the place.
So they use it a lot for trading.
For trading, what type
different
of trading?
cryptocurrencies.
Cryptocurrency trading.
If you want to sell, you go back to the stable one, then going back to another cryptocurrency. You don't have to go into the banking system.
All right, so maybe it's also being used for trading. So I've heard that it dampens volatility, I agree. It could be used for trading because you might go crypto to crypto to crypto, but you want to keep a better store of value and a stable token as well. And that's what it's been. I list 4 different approaches to it. These are design features. They all are trying to do the same thing. Have a cryptocurrency that's not centralized, or at least not backed by a government, not centralized that way. It might be centralized that the algorithm and the software is centralized. And 4 different design features. And I think there was a reading on this, if I remember. Does anybody want to say anything about Tether? I mean, what, basically backed by US dollars?
Stephanie?
Well, I was saying, I think like one of the big issues with it is that if it were to be like really adopted, you would need to have a ton of collateral to make it like useful to people. And then the other issue is that you'd also probably need a central bank like the Fed to actually like, you know, be there intervening, and that kind of goes against the purpose.
So Stephanie's saying if it really took off, you'd need a ton of collateral. What if Tether, or any fiat collateralized currency, was not just a couple $1 billion, but it was $1 trillion or a couple of trillion? the whole U.S. banking system is about $16 trillion. There's 13-ish trillion dollars of deposits. What if you had a coin that's 1 trillion of that?
If it's supposedly backed by, if it's that large and it's supposedly backed by US dollars, you have three choices, right? You either have a stack of hundreds for $1 trillion, physical, actual paper, or you have bank deposits, which is what you're trying to get out of, or you've got the money with the Federal Reserve, which you're also trying to get out of. So those are your only three choices for where actually is the collateral. It has to be something.
But the reason to drill into this is part of the motivation of why central banks are looking at central bank digital currency. They've been watching not just Bitcoin and the whole crypto space, but then they've watched stable value tokens come along. Stable value tokens that are generally backed by some blockchain technology and blockchain initiative. That, frankly, they don't have to be blockchain. I think you could build something without it.
If you have like a fiat collateralized stablecoin like Tether, I can understand why there's a technological use case. Maybe you want to use it as a sweep account for trading, or you want to lock value on a blockchain that's not volatile. And there's also a business case where if it does go above $1, the coin goes above $1 or below $1, you can either issue more and keep the difference, or buy back more and keep the difference. And you can potentially, if it's small enough, you can invest in the central bank, but a bank, you can get interest on the collateral. But I do agree with you that the problem comes along when you have like this huge scale, like $1 trillion. But then at that point, maybe, I don't know if it's $1 trillion or 10 trillion or a couple billion or whatever, but wouldn't you run into the same type of scenario where the US dollar went off the gold reserve? You just can untether it to the reserves of the coin, because it's so widespread and ubiquitous that stability is now.
So is your thought being that if it really grew and it was accepted in commerce, that maybe it wouldn't have to be tethered to the fiat currency, it would then become trusted, the way that the paper currency became trusted, and Richard Nixon in 1971 could say, we're no longer going to follow Bretton Woods, or in 1933 when FDR in our country said we're going off the gold standard.
Yeah, and with that you would probably need to create some kind of central authority that manages monetary policy, then it becomes fiat.
I think you raise an interesting point. I think we're well before that. I think right now, though, the interesting thing is there's a lot of entrepreneurial activity in stable value tokens. My observation is one of the leading reasons is, it was stated right here, that in the crypto exchange markets, which we'll talk about next Tuesday, in the crypto exchange markets, a lot of people want to go and trade crypto to crypto and not crypto to fiat. And what are some of the regulatory or economic reasons they don't want to trade crypto to fiat? Tom? Taxes. Anything else? What's another big thing that
Potentially be traced.
It can potentially be maybe more readily traced. Ben?
KYC and AML.
So KYC, you want to remind the class what those letters mean?
Know your customer and anti-money laundering.
So there's a whole regime around the world. In the U.S., it's called the Bank Secrecy Act, but around the world about knowing one's customer, tracking anti-money laundering, and so forth. One of the dominant things in crypto that's going on, maybe mistakenly, maybe just because it's an early stage, is that some people who have crypto assets feel, I don't want to trade that for a fiat asset. I don't want to trade into euros or dollars or yen, because then it's more likely the official sector can track me. For taxes, I think there was a false notion that if I sell something crypto and I buy something else crypto, I do not have to report my gains or losses in my taxes. Now, the U.S. has clarified that you do, but for a couple of years, people were going, well, maybe it's just what's called a like-kind exchange. like selling one piece of real estate for another piece of real estate. By the way, if you sold gold and bought silver, gold for silver, that was not a like-kind exchange under U.S. tax law. But there were tax advisors going around saying, well, there's some ambiguity. Maybe you don't need to pay your taxes if you went from Bitcoin to Ether. The tax bill that was passed in December, let's call it the Trump tax bill, that closed that window. One of the few things that closed. But I think because of illicit activity, because of taxes, there's still a lot of people that say, I'd just rather go crypto to crypto. But there's one other thing, the reason why people might want a stable value token about the payment system. We talked about it last week. Do I see a hand up? You help me out?
I was going to say it's quick and it's very cost efficient.
So it's quick and it might be cost efficient. We talked about, and I had a chart about it, using crypto as a bridge currency to move cross-border payments. If you're moving from US dollars to Mexican peso, that can take 2, 3, 4 days, and correspondent banking systems and the like. But what if you use from US dollars to crypto to Mexican peso? Very legitimate use case that can lower your cross-border payment down to seconds rather than days. Very legitimate use case that maybe stable value tokens would be a good use case. So, again, if anybody's interested in the different design characteristics, it's interesting, there's a professor over at Harvard that came to see me, he teaches Harvard Business School, came to see me that he's creating a non-collateralized seigniorage-based stable value token. So just even here in Cambridge, there's a bunch of people looking at trying to create things and do things, and a lot of energy. You're always asking me, what's a real use, blockchain use? Some of it's just in this area. Hugo, and then we'll move on.
One other thing with a couple of the fiat collateralized ones that you don't have up on there. So like Gemini, the exchange, recently created one, and Circle created one that Coinbase adopted, and those are both on top of Ethereum. And I think actually, at least with Gemini, I'm not positive about the Circle one, like coded into the smart contract is the ability to freeze tokens. So like you could say that's like an AML type of thing, right? Like if they see something going weird with transactions with like GUSD, then they could actually like stop and seize tokens.
So what's the mood of the class around stable value tokens that can be frozen right in the smart contract? Does that seem in the spirit of Satoshi Nakamoto? What's that, Hugo? No? Ross?
I have a question.
Yeah.
Who's they?
Gemini. Whoever wrote the smart contract.
Whoever controls the smart contract. In that case, that would be a crypto exchange run by, who's Gemini run by?
Winklevoss brothers.
A couple of identical twins, not the Genslers. Well, the Genslers weren't in a movie and didn't make a lot of money on crypto. The Winklevoss twins, by the way, who were at the wonderful story with Mark Zuckerberg at Harvard, if you remember the Winklevoss twins, and they're rowing, part of a rowing elite too, have made a lot of money in crypto. And we'll talk a little bit about them next Tuesday. So then central banks and cryptocurrencies. We talked about this the other day. There's 4 things they're really doing. They're monitoring and studying. Some are restricting the use, like the Central Bank of China. Some are trying to do payment system experimentation. We talked about Singapore and Canada. Those are real blockchain initiatives, the payment systems. School's still out as to whether they need to use the blockchain technology. But they are seriously leaning in, particularly in Singapore and Canada, saying there might be a more resilient payment system if we use a decentralized, distributed blockchain technology based on Quorum or Corda or Hyperledger Fabric. I think we're a few years away from them sort of coming, is there enough there that it would be better than traditional databases, but they are definitely putting a lot of energy. And even the European Central Bank with the Bank of Japan has an initiative as well. But in the fourth category, central bank digital currency initiatives, I caution everybody, you don't necessarily need to use blockchain technology. This is the part of the course to say this is something clearly inspired by Satoshi Nakamoto's innovation and inspired by stable value tokens. But when we talk about the Bank of Sweden's initiative and some of these other initiatives, you'll find that, to my knowledge, they're not built on blockchain technology. That doesn't mean they couldn't be in the future, but I think they're important because they're really important to blockchain and money and how central banks are thinking about this area right now. We talked about this last week, that the first wave of payments were all on Ethereum, and as I said, they've moved on from Ethereum, and the second wave of the payment system initiatives are all permissioned blockchains, and now they're looking at a third wave. If there's further questions about how central banks are looking, I'll take them now, or we'll go on to the central bank digital currencies. Please.
What do central banks currently use to manage whose deposits are whose?
Who's what?
If it's Morgan Stanley's deposits or Goldman Sachs deposits, when they exchange deposits within the central bank, what do they currently use to manage?
They use various forms of traditional databases, and I'm not going to pretend that I know exactly each of those databases, but they usually, for interbank money, as you talk about Morgan Stanley or Goldman Sachs, they would call it the real-time gross settlement system, RTGS system. But the actual underlying database structure, frankly, probably goes back to batch processing. Most of them are still batch processing. In the U.S., I think we'll roll out a faster payment structure in 2020. And Shreem, who was visiting with us, was on a whole big advisory group to the Federal Reserve to do that. Does that help a little bit? But the question really is, could blockchain technology inspire the next generation for the mid-2020s for any of these countries to have 24-hour, 7 days a week, but also no one central place where the ledger is kept with multiple parties sharing the ledger? And as Lean said, but wait a minute, wouldn't a central bank still want to have authority over the protocol amongst 20 or 50 banks? And the answer is probably yes, but they're trying to explore what's the most resilient system. So central bank digital currencies. The central banks, of course, already issue digital reserves, so the real question is this. Should access be given to others? Should it be expanded to the retail public? And so these were the ones we chatted about. And we're just going to go through 4 of them quickly just to say, and you had a little reading on each of Ecuador, Senegal, Sweden, and the Philippines. These are the opportunities that the central bankers even talk about. Basically, in Sweden's perspective, they want to stay in the business of providing a means of payment. And the krona is so barely used. Nobody's here from Scandinavia? No. The krona is so barely used, they want to keep it having some influence. I'm trying to think if I put the chart in. I'm going to skip over a couple things. Nope, I didn't put the chart in, so I apologize. So what challenges do you think are really there from our readings? Which of these challenges do you think scares the central banks the most? Is it financial stability? Is it changing the credit intermediation of banks? Is it monetary policy? Is it the payment structure? Or is it all of the above? Aline?
I guess financial stability.
Financial stability, basically a run on the banks. I don't know. I would say that in my conversations, and Rob Ali has many more of them, but my conversations with central bankers, it's a mixture of the first one, the one Aline did say, and then basically the third one, credit allocation. That they feel like if we insert the central bank more directly into taking retail deposits, are we going to be inserting the central bank more into credit allocation? Or in essence, if we shrink the need for commercial banks, are we somehow shrinking the credit allocation in the economy? So in normal times, they worry, in essence, about credit and the extension of credit. And in crisis, they worry about that it would be destabilize the system. That's been my experience talking just in these 8 months to central bankers. Isaac.
The central bank is taking the deposits rather than the commercial bank. Wouldn't that just be reflected in a change in the interest rate because they would have the underlying funds? And so that might just flow back through when the central bank is determining the federal funds rate, it would be adjusted. And so corporate borrowers would be able to borrow cheap.
So what Isaac's saying is, couldn't you just address this as a central bank through interest rate policy and some differential interest rate and the pricing of money? And I think some would contend you could. But on the other side, anybody want to take the other side? The question really is does the central bank want to start making loans? Now, the U.S. central bank has a $4.5 trillion balance sheet, as we talked about 2 days ago, and owns about a little less than $2 trillion, $1.5 trillion of mortgages. So in a sense, the central bank is already making a credit decision. They're lending to the mortgage market. But the question is, do you want to go even further and have the central bank picking individual companies or individual homeowners to lend to? And that's what, if it got to any scale or size, they talk about. Of course, they could just lend to the commercial bank system, and then the public would be lending to the central bank, and the central bank would be lending to the commercial banks. So the design considerations, and we didn't talk about these 8 design considerations are all in the loop. Does everybody get it? Do only a few people get it? Is it token or account? And so forth. This little money flower that Garrett has put out there, and central banks talk about the money flower. Where's Bitcoin on this? Who wants to tell me where Bitcoin is? We'll bring it back to blockchain. Ilan.
Private digital tokens, wholesale only.
Wait. So where am I pointing?
Blue and orange.
Blue and orange. Oh, it's written there. You mean right there?
No, without the red.
Without the red, right here. Private digital tokens, wholesale only? No. Tell me where you want me to point. So you're saying it's orange and what? And blue.
I think it's not widely accessible. It's not.
It is widely acceptable. Bitcoin's widely accessible, meaning anybody can get it.
All right, yeah. So there. I was confused. You access that.
I would say you can put any form of money into one of these little blocks. Government-backed and not government-backed. We're stable value tokens. Look at this. You're the closest, and I can't remember your name. Connery. We're stable value tokens. Well, it's not central bank issued. I'll give you a hint, so it's not in the green.
Maybe in private digital?
Yeah, it's private digital tokens. You could make it wholesale only, or you can make it widely accessible like this.
But they can be, and most of them are centrally issued, even if it's not a central bank. I guess it depends on how you define central bank. If it's not a sovereign central bank, but it's one entity that issues a token that's tethered to the U.S. dollar and it holds the U.S. dollar.
So I think it's an excellent point. A stable value token that is backed by a fiat currency is not central bank issued. I would say that it's not in the light green, but it's highly dependent on the central bank. It's highly dependent on putting deposits in commercial banks. Tether, which purports to be a little over $2.5 billion crypto, which is all backed by U.S. dollars, at one point in time last year, they lost some of their commercial bank accounts, meaning the commercial banks would not take their dollars. The commercial banks in many countries said, forget it, I can't have you as a customer, I can't follow you for any money laundering and otherwise. And so that, in essence, you're highly dependent if you're a custodial stable value on the central bank. I agree with that. But I think you're not central bank. There's a little.
I don't think so either. I think it's just central.
It is central, right. So there's a lot of paradoxes and irony in the blockchain crypto space as to how centralized something is, how decentralized, and from Satoshi Nakamoto's very decentralized way. So we're going back to these, and so Ecuador. Anybody read the Ecuador thing? Want to tell us a little bit about Leonardo?
Well, I think it was a story of failure.
Story of failure.
Because the government issued the electronic money and was backed by the central bank, but the central bank had no credibility or trust from the users. So it never took off. So the government of Ecuador had just defaulted a few years before they launched this. The economy was dollarized. So they issued something where people didn't really know whether it would still be there within a few years. So the usage was extremely disappointing compared with the initial expectations.
But another interesting point in that article was that financial institutions were not obliged to use it whatsoever, and I sort of wonder if there had been like a minimum level of, balance sheets at these institutions where they were required to have a minimum level of the cryptocurrency. Could that have helped it a little bit? I don't know.
As far as I remember, they also failed to manage expectations because even in the first year, what they are saying, what they are claiming is there are going to be 500,000 users or something, but turns out just 5,000 accounts or users came up. So it's a great story of failure.
Great story of failure here.
A good point was also the mismatch in benefits and costs that were associated with the project. They kind of after calculations were made, the benefit were less than $1 million compared to almost $7 million that the whole implementation took. So was from the start, from the outset, the design wasn't conceived in an appropriate manner.
And again, this is somewhat inspired by crypto finance. No blockchain technology involved in it, which, by the way, is going to be true for the next 3 examples as well. But it's relevant. This is sort of also inspired by initiatives like M-Pesa and so forth. It's like, how do we get more inclusion and use dollars? Kelly, and then we'll go to...
I feel like it was less of a, I feel like it was less of an attempt to take some new digital currency initiative and more of an attempt to make profits, because they said that basically the state had a monopoly on this. And as Leonardo mentioned, there was previously hyperinflation. So once they discovered that it wasn't really getting them the profits they wanted, and there was that, right. So I sort of wonder if really the motivation, I don't really think, was to do a proper job on the technology.
I think you're probably right about that. One good thing that came out of it, they finally sort of admitted that they shouldn't maybe be in the monopoly, and they let mobile phone payment alternatives were authorized for the phone companies. But I'm not close enough to Ecuador to know whether that was really done. Maybe it's now just a duopoly of a couple of phone companies doing it. So they might have just shifted some economic rents from the government to a couple of major companies that are friends of the government or something. The Philippines. I think there was a reading on anybody want to say something about, anybody from the Philippines? No. Anybody want to say something about what happened in the Philippines? And you're going to see something that's similar about this in Senegal. There's a software provider called eCurrency Mint Limited in Ireland that is marketing around the globe to do digital fiat currency. I think they're careful. They call it digital fiat currency rather than central bank digital currency. But nonetheless, every time there's a press release, whether from the Philippines or Senegal or elsewhere, there's somewhere in the press release you see blockchain technology use for. I've done my best to read everything I can on these two since last summer when I stumbled upon them in July. I do not believe that either are using blockchain technology, but they're sort of using the gloss of the terminology. But it's still, Senegal more than the Philippines is something that central bankers are looking at. Importantly, it's issued by a commercial bank. It's not technically issued by the central bank. The central bank has actually put out a statement and saying this is a test and a learn thing in a regulatory sandbox. So the central bank is sort of saying, all right, this is a little bit more akin to private banknotes in the 19th century in the U.S. And I'll flip to the Senegal one. This is in the West African Economic and Monetary Union. So there's a monetary union, I think, of 14 countries all using a currency. It's called the franc, I think. The F, is that?
They call it just SEFA when they use it.
What is it?
SEFA. They used to call it SEFA.
SEFA. Yeah. Have you ever used it? Do you know it?
In Central Africa, yeah.
So one country in a 14-nation bloc has said, we can maybe get more financial inclusion. Good. I think there's a good motivation there. We can get more financial inclusion. We can put SEFA, did I say it right? SEFA on an electronic platform. We'll use this software provider out of Ireland that keeps knocking on our door. And we'll see if we can push it out a little bit under some e-money regulations. Technically, it's e-money under pre-existing regulations. But I would say a lot of central bankers are kind of elsewhere around the globe, sort of watching what does that do? What does that mean? Does it increase financial inclusion? And probably the most interesting one really is in Sweden. Sweden has said these are the benefits. These are written in a document. They've written now their third document on this. It came out a couple of weeks ago. It was not a signed reading because it just came out, and it's 50 or 60 pages, so anybody wants to log through it. They say it's going to continue the public access to the risk-free guaranteed means of payment. That's the key thing to them. You have cash in your pocket right now, krona, but very few people have it. So few people have it that most retailers in Sweden are now saying, I will not accept krona. And it's not such a big country that a bunch of people want to own krona for a store of value. So the total outstanding, was there a question?
Because like all the companies that are listed, they're listed in kronas, like in Stockholm. So like how come it's not used at all, but like the stock markets use it widely?
The stock market what?
Like the companies which are listed, they're listed in kronas, right?
Correct.
So like how come it's not used at all?
It's not
used.
Well, no, krona is used digitally. I'm saying paper krona is not used. Paper krona. But they're saying we maybe want to make sure that there's a government's direct relationship to electronic government money. The properties, they've said they're willing to put a comprehensive range of services in, make it widely available. They've answered the design considerations, and they actually say that they're looking at putting interest rate on this. They think that putting an interest rate on it makes sense. And that it should have e-identification. They say it will be traceable. They've already said in their documents they're not going to go with a totally anonymous e-money. This is out of their report, but as you can see, the blue line is Sweden, that their total outstanding cash, this is physical tokenized cash, was 4% of their GDP. It's now less than 2% of their GDP. The US and Europe would be the green line. We're up to about 10%. But as we talked about on Tuesday, 8 of those 10 points in the US are $100 bills. And 4 or 5 of the 10 points in the US are outside of the US.
Is part of this because bank deposits or reserves or what we would hold in vaults in dollars in the United States. The banks here are holding in euros.
No, this would be cash that's outside that the public holds, or the public can be
held in banks.
That is correct. So if it's cash that J.P. Morgan is holding physically, just because they're putting it in that daily ATM machine, it might be included.
But like the X number of dollars in everyone's bank accounts is bank deposits.
That's called bank deposits.
No, it's just M1.
This is actually only about half of M1. This is the 1.6 or 1.7 trillion dollars of it's about 1.8 trillion. 1.8 trillion in the U.S., of which 1.6 trillion or 1.5 trillion is $100 bills. There's only $200 to $300 billion of U.S. currency, paper currency, that is not $100 bills. And well over half of the $100 bills are outside of the U.S. per Federal Reserve statistics, I think 57%. How they trace that would be another story for another day. But Sweden doesn't have a bunch of people holding the equivalent of $100 bills or 500 euro notes as a store of value. And so you see a decline of their paper. You see the retail merchants aren't taking it. People aren't using it. So Sweden feels compelled to say, I want to do something here. Tuesday, we're going to be talking about crypto exchanges. It's a bit of a setup also for Thursday when we've got our outside speakers who I keep chatting about. I think Toledo had to leave early today, but I think Toledo is going to send you a message or put up on the website. Jeff Sprecher and Kelly sent a list of readings. I guess they're used to like being, they're not actually used to doing it. They're doing this as a favor for me. I got to know them very well when I was at the Commodity Futures Trading Commission. They're rolling out both a crypto exchange and a payment alternative. And so they sent a bunch of things that they thought you might want to read. So we put them up on the website midday today. I know that you've got a lot of other things to do, and it's getting to that time of year where there's fewer and fewer things you're reading. But what we're trying to do on Thursday is I'm going to open up with a little fireside chat. They want me to ask them a few questions for 10 or 15 minutes, and then we're going to open it up. It's all going to be your time. They're with us about an hour. Now, we might encourage them to stay till the end, but they're here from 2:30 to 3:30. Now, I know we always start at 2:35, but if they're ready to go at 2:32 or 2:33, I might start with them and start the fireside chat. And then it's going to be you're asking them questions. So to the extent that you read the things that they sent around, better for you. I will say this in advance because one or two of you have already come saying, I want to see if I could go work for the company that owns the New York Stock Exchange and owns Bakkt and everything. I will be glad to send whatever resumes or anything you want to Jeff and Kelly. I'll act as a clearinghouse and send it if that's your goal. But in advance, I'm not going to give their private emails to you and everything like that. But I think that will be an interesting conversation next week. So central banks play an important role in the economy. We already live in an electronic age, but they really are absolutely at the epicenter of money and how money's been defined for 300 or 400 years. Payment systems and fiat currencies have had challenges. I still continue to think blockchain, I told you I'm not a maximalist, but blockchain technology can be a catalyst for change. Central bank digital currencies is evidence of that, even if it's not based on blockchain technology. I think it's partly inspired and urged on by this. It doesn't solve what blockchain technology would do for it, but I think that central banks, by and large, are monitoring. They're exploring payment systems, and a handful are looking at the central bank digital currencies. I think, and this is my own prediction, though, with 180 countries, somebody, Sweden might be the one to do it, will be there to do some central bank digital currency. Venezuela says they're doing one backed by oil, so it might be the other end. Iran says they want to do one to avert sanctions. We didn't talk about that, but sanctioned countries are looking at ways to avert sanctions. So there could be countries in distress, countries looking to avert sanctions, or kind of first-tier economic countries like Sweden that are looking at it. So I will see you next Tuesday.